Welcome back to Accounting 5000. This is the second module of the 30 modules for Accounting 5000. In this module we're going to talk about Chapter 1 of your textbook, Accounting What the Numbers Mean. The first chapter gives you some background on accounting. Most of you are graduate students, so you're very familiar with what textbooks do in the first chapter. Background information, definitions, sort of setting the stage for what's going to come for the rest of the semester. And that's exactly what this textbook does. The authors begin by defining what accounting is. Accounting is a method of identifying, measuring, and communicating economic information about an entity. So you say to yourself, okay, why do we care about this information? Accounting information is used to make decisions in the business world. So the accountant's job is to go through, take all the information that's coming about through economic events, putting it all together in some usable form for investors and creditors so they can make decisions. The users, as we said, are people who want to take this information and do something with it. Those people can be management of a company. These are the owners, the shareholders, the people who are running the company, want to know what they're doing right, what they can fix, what they can do better. One of the major uses of financial statement information are investors and creditors. Investors are people who buy stock in the company or put their money into a company hoping for a return. Creditors, on the other hand, are people who lend money to a company and would like a return of a different sort. They are the people who lend money but want their money back. Investors typically don't have a term on their investment. Creditors usually do, a year or 2 years for a loan or a note. In addition to the obvious people, management, investors, and creditors, you also have other individuals that are interested in accounting information. If you work for a firm, you would like to know a little bit more about how well your firm is performing. So employees are major users. Along with employees, you could also include unions, who often use financial information in their union contracts. And finally, one of the most important users of financial information would be governmental agencies. People like the Internal Revenue Service, the Tennessee taxing authorities, the Johnson City taxing authorities, all use this information for various revenue generating activities. So there are quite a few people who actually use the information that accountants pull together. Well, who are these people that put this information together? We call them accountants, but that's a general term that covers a number of different activities that accountants do. Accountants tend to fall into some basic categories. For example, the first category would be financial accountants. These are people who actually do the financial statements we've been talking about. They prepare the information that goes into the disbursement of information to outside parties. And that's their major focus, is external reporting of financial information. Now, on the other hand, you have the people who are interested in the internal reporting of financial information, and we call these people managerial accountants. Managerial accountants look at costing, at products, internal information for managers. So if you have an external focus with financial accounting, you have an internal focus with managerial accounting. Financial accountants tend to go for the CPA designation. A CPA is a certified public accountant, which requires a certain amount of education, passing of a test, and some experience. The internal accountants, or the managerial accountants, go for the CMA designation, which is a certified management accountant, which again involves some education and some testing and some experience before you earn the designation of CMA. In addition to those two broad categories, we also have what we call public accounting. Public accounting is the area that you've probably heard a lot about in the news lately. These are the firms or individuals who audit firms, audit companies that are doing business. They will also often do tax work for people. You may see these people's firms as you drive down the streets of the local area. You will see Joe Blow's CPA firm. Those are what we call public accountants. They can be hired by individuals to do specific accounting tasks for them. They have no specific hiring by a firm. For example, they're not hired by Eastman Chemical or by East Tennessee State University. They are independent. In addition to those categories, we have internal auditors. Internal auditors do a lot of the things that external auditors do, except they do it for a firm internally. A lot of the focus for internal auditors is to make sure that the company is operating efficiently, that there are no lags, no problems. They tend to solve problems for the external auditors. In addition to internal auditors, we also have governmental accountants. These are people who work for governmental units like the IRS, the City of Johnson City, the City of Kingsport. They do a different type of accounting, which we'll talk about more in detail later on. And finally, you have the famous income tax accountants. Public accounting people will do income tax, but you also have the people in the income tax agencies who are accountants. The IRS hires accountants, the Department of Justice hires accountants, and the FBI hires accountants. We've talked about the different types of accounting. Let's talk about where accounting came from. The history of accounting is a very long and interesting history. We can find accounting records from as early as 3000 BC on clay tablets. You can even find them on the pyramids, where they kept track of transactions and trade based on stalks of wheat. But the first noted history of accounting that was actually documented was by a monk in Italy. His name was Luca Pacioli, and he wrote a book on geometry. At the end of his book on geometry, he included a lot of information about double entry accounting. We still use a lot of the terms and methods that Mr. Pacioli talked about in the 1400s. The accounting area grew over time. The Industrial Revolution played a big role in the growth of accountants because to make big pieces of infrastructure, firms needed a lot of capital. They needed money to grow, to make cars, to make furnaces, to make trains. So in doing that, what they would do is go out and gather capital. Well, to gather that capital, they had to convince people to give them the money. That's where accountants stepped in and said, okay, we will record all of this for the investors and for the creditors so they'll know where their money's going. So the Industrial Revolution was a big role in the development of accounting history. That ties into the U.S. accounting history in that the U.S. followed Europe not far in the Industrial Revolution, and accountants began to play a greater and greater role in the growth of the United States. They tried over the early years to come up with a set of principles, a set of standards, but were largely not successful. Then in 1933, 1934, we had two laws that were enacted by Congress called the Security and Exchange Acts. Those acts were a result of the stock market crash in 1929, and they enabled accountants to set some standards, to come up with a profession, and to typically develop into what we see as accounting today. So the turning point for accountants was the big crash and the laws that followed the big crash in 1929. In the SEC Acts of 33 and 34, Congress allowed the SEC, the Security and Exchange Commission, to set accounting standards. But the SEC in turn delegated that authority to the accountants themselves. And through a series of different standard-setting bodies, starting with the Committee on Accounting Principles and the Accounting Principles Board, we've evolved in having an FASB, a Financial Accounting Standards Board, that actually sets the standard for the financial accounting in the United States. Now that's not the only kind of standards that we have, but you're going to hear a lot about the FASB standards in the next few weeks. We also have governmental accounting standards. These standards are set by a Governmental Accounting Standards Board, and they typically govern how states, universities, cities produce their financial statements. We also have a CASB, a Cost Accounting Standards Board. Typically that board produces standards for people who are doing government contracts and how to account for costs on government contracts. One of the most important groups of standard setting right now is the International Accounting Standards Committee. This committee is in charge of setting standards for the whole world. And as you can imagine, it's a headache for a lot of people to try to come up with standards that every country in the world can agree to. And what the ISAC is trying to do is to bring together all the different standard setting bodies in the United States, Australia, Great Britain, Asia, India, South America, and come up with a set of standards that's uniform. We call that harmonization. We're trying to harmonize all the accounting rules across the world. It's a long process, but we've seen quite a bit of success in the past few years. So occasionally you will hear me refer to the international accounting standards, and I'll often bring in how they relate to the American accounting standards as we grow closer and closer in how we're going to do things. One of the things we always need to talk about when we talk about accounting in this era is that accounting is a profession. And as with most professions, accountants have a code of ethics. We call that the Code of Professional Conduct. And in the Code of Professional Conduct in accounting, we have some key words: integrity, objectivity, independence, and competence. Integrity means that what you say as an accountant is honest and forthright. In being objective as an accountant, it means that you're going to be impartial. You will not play favorites with any of the information or any of the individuals that you work with. Independence means that the accountant has no allegiance, no loyalty to anybody other than the right thing to do. And of course, competence is the one we're dealing with today, that an accountant has the skills and abilities to do the job correctly. So those four key words will show up again and again when you talk about accounting: integrity, objectivity, independence, and competence. In setting a standard using these terms of integrity, objectivity, independence, and competence, we have come up with what we call a framework for producing accounting information. We call that the conceptual framework. You can sort of think of it as a foundation for a building. These are the blocks upon which we build the way we do accounting. There are 7 statements that we call them, 7 concept statements, which we use the term in accounting. And we use these, again, as the building blocks for our Statements of Financial Accounting Standards, SFAS. There are about 150 statements of accounting standards, and these 7 concepts are the blocks upon which we have built those 150 statements. For example, what we say is that when we're producing information for investors and creditors to make financial decisions, we're going to produce that information for only one entity, for only one company, one individual. We're not going to mix an individual and the company in one set of records. You often see this happening in a small business when one person owns, let's say, just a little fast food market. You often see the owner mixing his bills in with the bills of the market. Well, in accounting, we divide those up. We say, no, the owner is separate from the fast food market. We're only going to report on the market or on the owner. We're not going to mix them. So we call that reporting by entity. So you may hear that term over and over again. We're reporting for one specific entity. We also use historical information. We do not change the information in the financial report simply because the cost of living has changed or the value of something has changed. We list the information on the financial statements at what we call historical cost, what we paid for it. The reason for that is that when we bought something, it was an arm's length transaction. When I went and purchased a car, I went to the car dealer and said, okay, here's the money I have for the car. He said, here's the car. We agreed to a price on the car. That's what we call an arm's length transaction. So that's objective. That's something that we can both agree on. That's what the car is worth. Now, one of the things we have to remember when we go through this, looking at historical information and recording it, remember that the information is costly. We have to spend money for people's time. We have to spend money for the computers that generate the information, the paper we use. All information is costly. So anytime we come up with a concept or a statement for producing financial information, we always have to say to ourselves, is the benefit we're going to get from this statement worth what it's going to cost us to produce that statement? And oftentimes we'll say, no, it's not really worth it. It's not worth the time and effort to come up with 2 cents difference on a multi-million-dollar financial company. so we will often judge benefits and costs. Now, in this conceptual framework with those underlying themes, we have come up with an overriding, what I will call a sentence that will come back to haunt you for the next few weeks. The objectives of financial reporting. The reason we do financial reporting. We do financial reporting for investors and creditors to provide them information about cash flow, the resources a firm has, the claims to those resources, so that those investors and creditors can make informed decisions. Those concepts underlie the basic objectives of financial reporting. We are providing information to investors and creditors about an economic resource and claims to those resources so that they can make informed decisions. That's the objective of financial reporting. And you say to yourself, well, wait a minute, I thought you just said a minute ago that all these different types of people were using the financial information. You told me that investors and creditors were using them, but so were managers, taxing agencies. Why do you say that one of the objectives of financial reporting is to provide information to investors and creditors? Well, in analyzing the uses of financial information, the accountants have found that if we can provide information to investors and creditors, the information they need to make decisions, that in that information is the information that all the other users also need. That by providing information to investors and creditors, managers have the information they need. Taxing agencies have the information they need. So even though we say investors and creditors in stating our objectives to financial reporting, realize that we're gearing it that way because that encompasses all the types of information that are really needed by the other parties. So we're not just limiting it to those two parties. We're using them as a proxy for all the users of financial information. So you have now before you just sort of an overview of accounting. As you read through the first chapter, you'll get a lot of information about the history of accounting, the objectives of financial reporting, all those sorts of pieces of information. So what I'd like for you to do is to take a few minutes and reflect on what you expect to come from this course. And there are two exercises at the end of Chapter 1. The first one is Exercise 1.3, and it asks you to write a paragraph about what you think about accounting and what it is that accounting people do. Just a paragraph, 5 or 6 sentences, just for yourself in your notebook somewhere where you'll keep it. Write down what you think accounting is all about and what you think accountants do. Once you finish that assignment, flip to the next problem, Exercise 1.4, and write down for yourself what you expect to get from this course. What do you want to have when you get through these 30 modules? Do you want to be able to know what companies to invest in? Do you want to be able to sit for the CPA exam? What do you want to get out of this course? Take those two exercises, write about a paragraph for each one, put them in a safe place. You can email them to me if you want them in a safe place. And we're going to come back to them in the last module of this term, and we're going to look at those and say to ourselves, have you learned anything? Has anything changed about your expectations? Have you learned what you wanted to learn? So that will be your assignment before you go on to the next module. Complete those two exercises, and we'll see you at the next module.